Hey everyone, Nick Shaheen here looking at banks. This is the XLF. Let's go to a daily chart, which is what most everybody look at. Where are we here? Different monitor. Okay, so there we go. I'll take out all the drawings. So the XLF is having a good day, but is not having a good insert time period here. So they are going into an earnings week, and this is the week that ends in the monthly expiration, so 7/17. And usually they stagger the earnings, right? So we got Citigroup, Wells, and JP Morgan, I think, on Tuesday, and then Wednesday is Goldman Sachs and a couple other banks, BNY and US Bank. I'm only concentrating on the big ones. And then Thursday we got Morgan Stanley and Bank of America. And those are the ones that I'm looking at. So how do I usually trade them? Well, there are some things to know. First of all, I was long into JP Morgan in a couple of ways that I shared with the members. So I'm not chasing into the earnings. If you remember on the last earnings, they chased them, and then when they reported, everybody got deflated after the fact, right? So that's the habit. They chased them. This time could be different, but I'm not banking on it. So you could take somebody else's money for that. Why could it be different? Because now they're booking loan loss reserves. They're not actually loan losses. They're saying it could be horrendous. So they're forced to say it could be horrendous. So from that perspective, the wildest one is Wells Fargo. JP Morgan is, quote, the safest one, and I think Bank of America is the safest one, but that's what they say, so I'll go with that. I'm worried about the big picture for them for forbearance plans. I bet you Americans don't know how to save. They love to spend, and now they're kicking the can as far as paying mortgages. I think like 8%, if not 10% of all mortgages are in forbearance, which means you kick the can down the road. And if you don't have excellent credit, when that can lands, you're going to have to come up with a pile of money or redo your loan, which means that you could be upside down. So there might be a problem for the banks down the line. It's just a concern. Okay, so here's the thing. If I buy calls in the report for the first batch, like in Wells Fargo or JP or Citi, and they report and they disappoint, those calls, done, dead. But if I buy those calls in Morgan Stanley or Bank of America or Goldman, then they will hold more value. Why? Because the event for those two, the ones that are out in time that haven't reported yet, still carries implied volatility. So even though they will move in sympathy, which is why I'm doing it, so they will fall if I guess wrong, but not by as much, and the implied volatility doesn't get crushed. The ones that report when the market opens, all the implied volatility goes back to normal, if not a little lower. And then if you didn't guess it exactly right, then your bet is gone. So the idea is to try to use outside bets, so outside of time, or make a blanket statement on the XLF altogether, so it's less direct. The reaction for the earnings is completely binary. You think you're doing homework and you think you're smart. I bet you anything, you tell the CEO of those companies, what do you think the market will do with your stock? They'll say, I don't know. So if they don't know, you don't know. And if you don't believe that, you're kidding yourself. It's a coin flip. The reaction the next morning is a coin flip. Eventually, you might do homework and be right, but the reaction, if you're playing the trade, it's a coin flip. Okay, having said that, I don't want to chase them. There is another way of doing it, the TLT. So usually bonds and stocks go in opposite direction. I say usually, it's not a rule, but it does happen, especially on violent events. And recently, that is more true for financials because they're tied to sensitive to the rates. So if rates are rallying, then they're rallying and the TLT is falling. Look at today's action on Friday. So if I'm already short the TLT, then I'm already long banks in essence. If I'm already long banks, I'm already short. If I'm already long the TLT, I'm already short banks. So I have to keep that in mind so I don't double up on my bets. All right, that's it. I can't get. If you're guessing, playing just the earnings, your guess is as good as any. You don't need charts or anything. But I can show you one chart, JP Morgan. I can tell you where I was long and where I was short. So let me get closer. All right, so I thought that there was risk here, and indeed it played out. I thought that they could fill the gap, but I didn't wait. I said I want to get long. I shared the type of long I would do, and I started it by going long the TLT because of the relationship I told you about, and both trades played out perfectly. So I personally didn't take JP Morgan, but I hope other people did. I did share it. But I did take the TLT in two ways, sold puts and bought calls, and that was a huge win into today. So that's the one chart, and I bet you they all look the same. I have not looked at Bank of America. I know it look almost exactly the same. So Goldman. Okay, Goldman is a little different. It's not a typical bank. So Goldman, if it breaks above 208, it has legs to go to 220, but it's not guaranteed. There's a big fail at 216, just under. What is that? Okay, let's go to the XLF at this time frame. Okay, so it's same. What is that? So multiple failures at 2370. They should take it out in order to get higher. And if then every one of these will be another place to book profits. All right, Nick signing out.